The first trading week of 2021 is behind us, and Elon Musk is now officially the richest man on the planet. I mean, who would have thought that back in 2017 he tried to sell Tesla to Apple and Tim Cook didn't even take the meeting? Now, if you want to do well in financial markets over the next 12 months, you have to learn from the lessons that 2020 gave us. Let me show you. Happy New Year, it's 2021. Now, most of us thought that by leaving 2020 behind, this whole strange and bizarre year would disappear. But then 2021 came and just said, hold my beer. I mean, just this first week of January, how strange was that? Now, when it comes to financial markets, we lived through some of the strangest and bizarre moments over the past 12 months. And if you want to do well in 2021, what better way than to revisit some of those moments and understand what lessons we can draw from those? I'll walk you through 7 charts that paint the picture. And just to start, just to warm you up, let's start with this chart of Apple here. Now, when you think of Apple, Apple is the largest company of the S&P 500, obviously. And they took 18 years to reach a $1 trillion market cap. Now, they only needed 18 months to reach a $2 trillion market cap. Now, looking at this chart here, between the trough and peak, between March and August of 2020, they added the entire market cap of Google. Google is the 4th largest company in the S&P 500. And just to put this whole thing into context, the market cap of Apple right now is bigger than the whole FTSE 100, the 100 largest companies in the United Kingdom. And by the way, Apple employs 130,000 people. The 100 largest companies in the United Kingdom, the FTSE 100 companies, employ more than 4 million people. 130,000 versus 4 million. So it just shows you the whole ecosystem and the margins and the profitability that Apple has and how that's reflected in the stock market. Now, the second chart of this whole crazy and strange year is what I call, would you like to get paid for oil? Now, if you remember back in April, there was a lack of storage for oil, and the front month WTI contract went negative to $40. So this was a hugely painful lesson, not only for oil traders, but also for people that invest in ETFs that are linked to oil. And more generally speaking, this is a lesson for every investor in terms of, whenever you think about a specific level that you think an asset is never going to reach. Well, here we had seen negative oil, right? People were getting paid oil just to take it off the hands of investors that had no way to store it. Now, the third crazy chart of 2021 was all about Nikola. And I don't mean the fraud allegations and what happened with the GM deal. What I mean is back in July, the borrow market went completely crazy. This was a month after Nikola went public via a reverse SPAC IPO. And remember, when you want to short a stock, you have to borrow the stock from somebody. You usually pay them a little fee, a few basis points, maybe 20 basis points, and then you're able to short the stock. So that's basis points. Now, Nikola's borrow fees went up to 600% annualized rate. So you would be paying 600% just to be able to borrow the Nikola stock and short it. Again, these are levels that have never been seen before. So another crazy story around Nikola, and obviously the fraud allegations and what happened to the stock after that with the GM deal that eventually didn't happen. That's a whole other story. Story number 4 in the list here is kind of a group of companies that don't actually make all that much money, but their valuation is ridiculously high, justified or not, right? So if you look at this chart here, you see the market cap of Zoom as a percentage of the market cap for CISCO. And when you think of Zoom entered 2020 valued at about $20 billion, right? And you see by October, at the peak of its valuation in 2020, they were valued at 160 billion, right? And yet you see that light blue line at the bottom of the chart here shows you the Zoom revenues as a percentage of CISCO revenues, right? That's not even 10%. Now, understand, I love Zoom as a product. I think it's an amazing company that will do amazingly well over the years to come. I think it's a superior product to CISCO. And others, Skype, etc. But again, their valuation probably went out of hand throughout 2020, as many other COVID stocks did. And now the other chart in this group I want to show you here is the market cap of Tesla compared to the combined market cap of Toyota, Kia, Hyundai, Nissan, Honda, GM, Ford, and all the other European auto manufacturers. So here in January, post the S&P 500 inclusion, the Tesla market cap is bigger than all of the other automakers in the world. And yet Tesla makes 500,000 cars a year, right? That's 1/70th of the overall auto market, and they're valued at more than that. So the market has never been more split. When you look at the analysts on Wall Street, they have never been more split as to where Tesla should be valued. But again, a crazy story of 2020, and we'll see what 2021 brings. The next bizarre story on our list of bizarre stories of 2020 was what Softbank did and how they broke the volatility market back over the summer. Now, you remember, if you look at this chart here, this shows you the skew for AMD, Apple, Amazon, Nvidia, and Netflix. Now, the skew in layman's terms is simply the ratio of how expensive puts versus calls are when you're buying puts on a single stock or on an index versus calls. So which one is more expensive? Now, typically, the skew is tilted in such a way that the puts are more expensive, right? The protection for your investment, so buying puts is your protection, that's your hedge, is usually more expensive than buying calls on a single stock. But the involvement of Softbank in some of these single names over the summer and the heavy buying of call options completely reversed this trend, and they kind of broke this whole skew market where a little bit ironically, you had to pay more to protect for the upside, right? You were spending more for calls than you were spending for puts. So they completely inverted this. And normally this only happens in takeover names, when you have a takeover over a company or in gold. But in normal markets, the skew is tilted so that the puts are more expensive than the calls. So this was a crazy story over the summer when finally it came to light who the buyer of these options actually is. And the market, I think, was very surprised to see that it's Softbank, obviously run by Masayoshi Son, who was involved in multiple stories over 2020. Again, another crazy story that kind of belongs to the list and shows you, if you're involved in options trading, what can happen and how the market can be broken relatively easily when you have a big giant whale player. Story number 6 in my list of bizarre stories of 2020 is what the Fed did, the huge money printing story. When you look at this chart here, it shows you that the Fed added $3 trillion between 2008 and 2013 in 5 years, right? So their balance sheet grew by $3 trillion in 5 years. In 2020, they only needed 5 months to add another $3 trillion, right? At this point, the Fed's balance sheet is over $7 trillion. There's been a lot of debate whether some of these capital allocation decisions that investors and companies made in 2020 were encouraged by the Fed. The fact that now they're buying high yield paper, ETFs, etc. But unquestionably, the fast reaction that the Fed came with back in March, April 2020 helped the markets recover a lot quicker than what we have obviously seen 12 years ago, back in 2008, when it took much more time for the Fed and the government to kind of get involved in the markets and bring the vol down. And the last story I want to talk about for 2020 is really our story. It's you and me. It's us. It's how we get involved in financial markets. Because 2020 was really the year of a massive retail investors' involvement in the markets, of trading platforms outages, of zero commissions, of organized forums for people to invest. And if you look at this chart here, it shows you, one of the many brokers, but this chart is for TD Ameritrade. It shows you the evolution of what is called the DAT, the daily average trades. So when you look at the volume of daily average trades over 2020, it completely exploded, right? Encouraged obviously by COVID, by people not being able to bet on sports, sitting at home and being involved in financial markets. Some of it fueled by the stimulus money, but really the whole world changed completely for retail investors, right? For you and I, we're not institutional investors, but now institutional investors pay attention to what the retail investor crowd is doing. They look at the statistics of the most highly held stocks on Robinhood and other trading platforms. And the retail investing base is a real driving force of what is happening in the market, especially for some companies like Tesla, for example, right? That has a huge following that just buys and holds to valuations that many institutional investors now will tell you that make no sense. All right, that was my memory lane for 2020 through those 7 or 8 charts that really told a story of a crazy, strange year and stories that we may never live through again. Make sure you like the video, subscribe to the channel if you enjoyed this type of content. 2020 for sure was a crazy year, but 2021 for now looks to be kind of starting off the same foot. And I'll be here to analyze what's happening, give you ideas and kind of help you navigate the financial markets. Be smart about your investing style, always have a stop loss, do your research, be careful in the markets, and always remember there's always the next trade. Don't get married to any single position, don't lose your capital, be careful. I'll see you in the next video. Good luck in 2021.